What happens to your money when a bank fails? The FDIC math most people have completely wrong. Chapter 1. The assumption most people carry one number in their head when they think about bank safety. $250,000, that's the FDIC limit. They know it the way they know their own phone number. And because they know it, they feel safe. The problem isn't the number is correct. The problem is almost everything people believe about how that number actually works. The FDIC, the Federal Deposit Insurance Corporation, was created in 1933 after nearly 10,000 American banks failed during the Great Depression and wiped out the savings of millions of ordinary people. Since its creation, not a single depositor has lost a single insured dollar. That record is real, it matters. But the gap between what the insurance covers and what most people think it covers is where real money quietly disappears. This video is about that gap, not to alarm you, to arm you. Chapter 2, How the limit actually works. Here is the first thing the $250,000 limit does not mean. It does not mean every dollar you hold at a bank up to $250,000 is protected. It means every dollar you hold in a specific ownership category at a specific insured institution is protected up to $250,000. That distinction sounds technical. It isn't. It's the difference between being covered and thinking you're covered. The FDIC insures by ownership category. A single individual account is one category. A joint account held with a spouse is a separate category. A retirement account like an IRA is another. Each category carries its own $250,000 limit separately. So a married couple with a joint checking account, individual savings accounts in each of their names, and IRAs for each of them at the same bank is not sitting on $250,000 of coverage. They're sitting on $1.25 million of coverage across 5 separate ownership categories, all at the same institution. Most people have no idea this structure exists. Chapter 3, where it breaks down here is where the documented mistakes happen. And they happen more often than any financial headline ever tells you. The first mistake is assuming all account types qualify automatically. Not every product a bank sells you is a deposit account. Money market mutual funds, annuities, stocks, and bonds purchased through a bank's brokerage arm are not FDIC insured. The bank's name is on the building. The protection is not on those products. This distinction is printed in the fine print of every brokerage agreement. Almost nobody reads it. The second mistake involves business accounts. A small business owner with a single operating account holding $400,000 at one bank is not fully covered. The business account is its own ownership category with its own $250,000 ceiling. The $150,000 above that ceiling is uninsured. If that bank fails, that $150,000 joins the line of general creditors. Recovery is possible but not guaranteed and not fast. The third mistake is the one that surfaced most visibly during the Silicon Valley Bank failure in March of 2023. SVB held a large concentration of deposits from technology startups, many of them far above the $250,000 threshold. When the bank failed, the FDIC initially announced that only insured deposits, those under the limit, were guaranteed. The uninsured depositors, holding the majority of funds on deposit at that institution, faced real uncertainty for 72 hours before the federal government made an emergency decision to cover them in full. That emergency decision was not required by law. It was a policy choice made under extraordinary pressure. The next time, the choice may be different. Chapter 4, The Math That Protects You. None of this requires you to panic. It requires you to map your own situation against a framework that takes about 20 minutes to apply once and then runs quietly in the background for years. The FDIC publishes a free tool called EDIE, the Electronic Deposit Insurance Estimator. You enter your accounts, your ownership categories, and your institution. It tells you exactly which dollars are covered and which are not. Most people have never opened it. The ones who have are rarely surprised by the result because they've been managing their accounts with the categories in mind. The practical strategy for anyone holding significant cash is straightforward. Spreading deposits across multiple insured institutions multiplies your effective coverage without reducing your access to your money. A couple holding $500,000 in cash across two banks in the right ownership categories can be fully insured without giving up liquidity or convenience. The math is arithmetic, not strategy. You just have to do it. Chapter 5, The Honest Conclusion. The FDIC system works. It has worked without interruption for over 90 years. The failure rate of insured institutions is low, the resolution process is fast in most cases, and the protection is genuine for the dollars it actually covers. But the system only protects what you've structured correctly. And the assumption that your bank is simply safe up to $250,000, full stop, is a simplification that leaves real gaps for real people in real situations. The SVB moment was a reminder that the edge cases aren't theoretical. They arrive on a Tuesday with no warning and resolve on a timeline that doesn't care about your payroll date or your rent. The number to remember isn't $250,000. It's the 20 minutes it takes to run your accounts through FDIC and confirm that the coverage you think you have is the coverage you actually have. That's not fear, that's the kind of quiet maintenance that keeps a financial life intact when things outside your control go sideways. We'll see you in the next one.